Here's an example of what we're talking about. From 1993, the 5 years following to 1998, if you'd bought a house in Port Douglas, they're around about 200,000. They've virtually doubled in growth over the next 5-year period, whilst the national average growth rate was pretty much flat, had about 20% capital growth. But then you look at the next 5 years, well, technically from 1999 to 2004, that trend had almost exactly reversed. Port Douglas houses had about 20% capital growth, whilst the rest of the nation doubled in value.
Welcome to the Microburbs podcast, where we bring suburb data to life. Learn from top industry experts, the best places to live, invest, and grow. And now on with the show.
So I'm joined by Jeremy Sheppard of Suburb Data and DSRData. I'm Luke Metcalfe from Microburbs. And today we're going to talk to you about something very important, a huge predictor of the real estate market, and that is mean reversion. Sounds complicated, I know, but I think when we get into it, it's going to make a lot of sense. So basically, there are two kinds of markets. You've got buyers markets and sellers markets. There are times where the price is too high, and there are times where the price is too low. It's rare to have markets continually go up or continually go down. Over 5 to 10 year periods, you have a reversion, something that's growing really strongly. Then that market has gone too far, and then it will pull back. When it's been really weak for a long period of time, then it turns around and comes back.
Yeah, so I just want to clarify, we all use this term mean reversion. So to those not familiar, mean is a different word for average. So it's just reverting back to the average. Over time, there's this tendency for all property markets to grow at the same rate, at the national average growth rate.
Yeah. So there are basically two kinds of markets, one where you overpay and one's where you underpay. We're not looking for mid-level markets where the price is just fair. You as an investor want to get in and pay too little because you know that the market is going to rebound again. And definitely don't get in at the top of a particular market.
Yeah. Timing is actually more important than people think.
Absolutely.
Yeah, and you hear from these old school property advocates and professionals, and they'll try and tell you that you can't time the market. Once you've bought a property, you should just hang on to it for dear life, regardless of what happens, because there'll be good years and bad years, but over the long term, everything will come good. And you can't think of property like you can in the stock market, where you do buy on a whim and sell on a whim too. There's a lot involved in buying property. It takes a long time, so you should just hold for the long term. And I'm always a little bit surprised at these old schoolers when they say, as soon as they say you can't time entry, I'm thinking, yeah, you can't time entry. You don't know. Well, they're more or less broadcasting to investors. Eeny, meeny, miny, mo. So I've always thought, isn't this really bad content marketing for you to say that you can't time entry into the market? You're effectively saying you don't know where capital growth is going to happen.
Yeah, absolutely. So a really strong point there is it's hard to just look at a graph and know for sure. There's a lot of things going on in the market. And part of the solution there is to use algorithms, the kind of algorithms that ended up taking over the stock market. So most trading that happens in the stock market is done by AI algorithms. They can just take in so much more. So you can have a market that's been trailing for a long time, and you think, oh, it's got to spring back because of these other three markets that you've seen. But the AI has seen thousands and thousands of markets over a 30-year period in the case of our AI. So that can give you more confidence of when to get in and buy.
Yeah, and I think that, just to be fair to the old school, I believe it was good advice. Back in the day, it was good advice because we couldn't predict. But now we're in the 21st century and there is all this AI. We do have a reasonable degree of confidence. I mean, the algorithm is not going to tell you, hey, capital growth is going to be 32.1% over the next 3.5 years. It's going to say it's most likely going to be 32.1%, with this margin of error, which you data scientists call confidence interval.
Yeah, absolutely.
So it was good advice back in the day. Now in the new day, it's not the best advice.
Yeah, absolutely. So you could say that if a market does go down, then okay, just wait. So if you bought and 5 years on, it hasn't moved at all, or it's even gone down, we're going to show markets that actually move back even in terms of even dollar value. And so you might say, oh, well, if there is mean reversion, if it is going to spring back, then you are going to recruit. That's an argument for staying in the market. But we're here to propose a better strategy, and that's to not invest in overpriced markets in the first place.
Yeah, that's right. Yeah, get it right from the get-go.
Yeah, so we're here to tell you in this video that there isn't some magic ticket to wealth. There's no golden stairway to heaven. Every kind of investment, a smart investor is always actively reviewing their portfolio.
There's a better strategy. It's not just hold long-term, that you can actually trade property and you'll be staggeringly better off. And this is because of this mean reversion, because you can time entry when a property market is about to surge in growth. And then we know from looking at historical data that there's going to be a flat period, and that flat period will go on for quite some time. During that flat period, you could have sold your property and bought in the next growth market. So it's a case of changing ship at the right time. It's this horse, we thrash it, it runs out of puff, and then we change horses and accelerate again.
It was great advice back in the day for these property experts to say. There was much less data available, and there certainly wasn't AI being applied for the property market. Whereas today, we have a huge amount of data. We have AI that can pick the right time. So you should, as an investor, be thinking about being an active participant. So you shouldn't just leave your portfolio alone. There's no guarantee for life. So people don't have a job for life anymore. They don't have a spouse for life. So why do you think that you'd have an investment for life? The world is speeding up. Some things are overvalued. Some things are undervalued. So what we're here to say is that a responsible investor is continuing to review their portfolio, buying in when things are cheap and selling when things are expensive.
Yeah, and a lot of people are immediately going to be thinking, well, aren't I going to be losing everything in capital gains tax and paying an agent a commission to sell my property, and then I've got to buy a replacement property, I'm going to pay stamp duty. So the exit costs and the entry costs, re-entry costs out of and into the market are quite exorbitant. But the difference in capital growth that you will get from swapping property markets is so astronomically high that it completely trumps all those costs of exiting. Now, this means you need to know when the right time is to exit a market and which of the new markets to enter are the best markets. So there needs to be a significant difference in the capital growth between your current property and the next one that you're going to buy. So it's not a case of just sell every 3 years. There is some technology to it. But once we've applied the AI, we can see that trading property is significantly more profitable than just holding for the long term.
Yeah, that's absolutely right. And it's not a simple matter of just finding a suburb and finding where it is in the market timing. There are going to be suburbs that are just ticking along. You need to have good analytics to tell you which out of all of the markets out there, which are the markets that are really going to give you that confidence about where it's going to be in 5 years' time. And yes, absolutely. So in terms of the covering the transaction costs, we're going to show you markets today that have doubled and more in value over that 5-year period is what we're looking at. So that more than covers all of your capital gains tax and your real estate agent fees and land tax, etc.
Yeah, so the difference between a good property market and the one you're currently owning an investment property in, that's called the opportunity cost. And an opportunity cost of as little as, say, something like 30%, certainly 50% can be enough to justify spending all that money to sell the property and buy a new one. So there is a cost, but if the opportunity cost is greatly higher, then it's worth the effort.
That's right. So another reality is that life is speeding up. So people don't hold properties forever. So there are a lot of reasons why investors would want to sell. There's things like they might have changed spouse, they're changing jobs, they're moving for different opportunities. We're in a world of fast fashion and TikTok. Everything is speeding up. So a big thing is that investors actually hold properties for less time, our data has found, than even owner-occupiers who are having to move every time they change jobs and to a new city, etc.
And I'd like to add that, if you do have this 30-year horizon, and, what is long-term, investing for the long term, some people would say 20 years. I think most professionals talk about 30 years. I've heard one professional actually say 40 years. I thought, gee, you want to start thinking about investing in property when you're sitting for your HSC, when you're in your final year of school. So here's one of the issues. If you get it wrong over a 30-year period, you don't have a chance to learn from that mistake and then go again. You've run out of time. But if your focus is much shorter, for example, say 3 years, within, say, 2 years, you've realized, okay, you've made a mistake there, and you learn from that mistake. So over a decade, you've still got time to learn from those mistakes, put those learnings to practice, and do a better job. Whereas if you have a 30-year plan, it's too late once you found out. And I would love to ask some of these, and I have asked this in the past, these professionals who claim to be experts at picking growth hotspots over the last 30 years.
If you were just holding for all of that entire 30-year period, you won't get a chance to go again. And what we also know is that investors actually do underperform the market. And the longer they hold, the worse the capital growth. So per year, the capital growth gets less and less. So,
that's
and
amazing
most
statistic.
investors only have one property. So that's like 70%. You wonder how many of them actually would have gone for extra properties. What was their dream? Was it to have more than one property?
Yeah, and I think they got disillusioned because they've bought one of these stereotypical investment properties that's underperformed. And one thing I would, every now and then I ask some of these experts who talk about, these old schoolers really, who talk about buy and hold, set and forget. And I ask them, well, what's your idea of long term? And they'll say 30 years. And I'll ask them, so what were you picking where were you buying for your clients 30 years ago? And I'm amazed how many times I say, oh no, I've only been in the industry for 15 years. So hang on a sec. You're telling me you're an expert at picking over the long term, but you've never done it before, not even once. You don't have a track record. You're asking me to hop into a helicopter with you because you're claiming you're an expert helicopter pilot and you've never flown before. I mean, that's absurd, but that's what they're saying. So there's no track record. But if you've got a track record for the short term over 3 years and you can show time and time again you've been successful with this, then I'd rather place my money on that. That seems to be more of a sure thing than wait and hope for 30 years.
Yeah. How many property professionals have been in the game for 30 years? That would be extremely rare. So
yeah, they do exist. They definitely do exist. But yeah, I don't want to wait 30 years. I mean, as soon as they say no one can time the market, they're broadcasting their lack of ability to use AI.
So, for starters, to be in the market 30 years, you must be at least, let's say you started at 18, you have to be at least 48. That's not what most people are in the property space. A lot of people are younger than that. Yeah,
and even over that 30-year career, they may have changed their minds as to where to buy from learning. So
absolutely. Yeah.
Well, let's get into some of these examples. Unless you've got another point there, Luke.
Yeah, sure. So I guess one other point there is that Australia has changed a lot in the past 30 years. Yeah, it's a different world to in the 1990s. We have far more migrants now. Our capital cities are much more of an international draw. We don't have the same cultural cringe that we had when you and I were growing up. So yeah, it's a changing world.
Actually, yeah, and that reminds me one more point with this 30-year plan. There's just so much more potential for things to change in that period of time. Magnetic vacuum levitation tubes is how we're all getting around now, 30 years into the future. As soon as you narrow it to, say, 3 years, yes, there can be technological changes, but the chance of that having a significant impact on your investment decision you made 3 years earlier is much smaller than if you made a decision that's banking on everything going according to plan over 30 years.
That's right. So we've got big threats and opportunities coming ahead, AI and climate change. There are really obviously geopolitical strife, so the potential of war between China and the US. There's a whole lot of things that nobody knows the answer to. So if you think that property is just something that you're just going to sit on and the world's not going to change and Australia's going to be the same in 30 years, I would say the one thing you can bank on is that things will change.
Yeah, that's right. But they do change relatively slowly. So if you have a short-term horizon, you've got less exposure to that risk. Long-term horizon, it's huge.
Yeah, that's right. So as an entrepreneur myself, I've often seen amazing new technologies that could be massively disruptive, but the reality is inside big corporations, people are still using Microsoft Word and Excel. And, it takes a long time for these technologies. It can take 5 years for these technologies to really take over.
Yeah. All right. Hey, you've put together some awesome charts here. Can I kick off the first one?
Absolutely.
Cool. All right. So here's an example of what we're talking about. From 1993, the 5 years following to 1998, if you'd bought a house in Port Douglas, they're around about 200,000. They've virtually doubled in growth over that next 5-year period, whilst the national average growth rate was pretty much flat, had about 20% capital growth. But then you look at the next 5 years, well, technically from 1999 to 2004, that trend had almost exactly reversed. Port Douglas houses had about 20% capital growth, whilst the rest of the nation doubled in value. So if you hung on to your Port Douglas property for the next 5 years, you would have missed out on a doubling in value, which is phenomenal.
Yeah, absolutely. So thinking from your 1993 mindset, you might be looking at Port Douglas and saying, what an absolutely beautiful part of the world. So you've got the Great Barrier Reef, you've got the Daintree rainforest, you've got this beautiful new place to move to, or for tourism, gateway to the north. And yes, you would have done extremely well. But that gateway, even as Australia was opening up in the 2000s, the rest of the country did better. So you couldn't just go into it with this mindset of like, what is the overall value of Port Douglas? Because these prices are fluctuating regardless. And the reality on the ground, if you're looking at a 5-year time window, that is much more important than any long-term attractiveness of the area.
Yeah, I mean, the Great Barrier Reef hasn't moved since, but over the next 5 years, if that was a draw card, well, it didn't work in the next 5 years. And even worse is if you had chosen 1999 to be the time to buy in Port Douglas. You can see why you get that wrong, and you've noticed the rest of Australia has taken off, and you're sitting there on something that's only grown by 20% over the same period of time. You can see why people say, nah, had enough with property, doesn't work, I'm out, I don't know. So yeah, definitely timing is very important.
Yeah. Take another beautiful sanctuary, the Sunshine Coast. You have seen, so if you bought in 1997, you would be looking at no growth up until 2002, despite the rest of the market soaring ahead 60%. But then if you had got in on 2018, September 2018, you would have seen 2.4x, so 140% growth, while the rest of the country only got 40% growth. So
we're talking about staggering differences here. This is not just a way of marginally improving the profitability of your portfolio. This is really significant. But Luke, some people are going to say this is regional Australia. Capital cities is where it's at. You have the education, the amenity. There's a draw card there for migrants, and that's where Sydney and Melbourne is where most of them land. And we should be focusing on blue chip suburbs. So, do you have any charts, examples?
Yeah, absolutely. So Cottesloe is like the Bondi of Perth. It's right near the city, very trendy place. And that is reflected in the growth from 2003 to 2008. So if you had bought in October 03 and then sold in 2008, October, you would have achieved 2.6x, so 160% growth. Pretty amazing. And, this is Perth. It's a major capital city, one of the largest in the country. But then subsequently, 2011 to 2017, you're looking at an actual decline in the value, while the rest of the country grew 30%.
Yeah, again, these are just staggering differences. But again, Luke, I can picture people arguing that Perth is just an oversized mining town. I want a more diverse economy, inner city metro suburbs, the genuine blue chippers. Have you got any examples of that?
Yeah, absolutely. So North Adelaide, this is like a classic inner city hip suburb. It's surrounded by park, just like the CBD of Adelaide itself. And the market as well was a big fan. 2007 to 2012, we got 90% growth there. So almost doubling of the value of the property. And this is looking at same property sales here. So we're looking at the actual individuals who bought a particular property and then sold them. What did they get? So pretty massive.
Yeah.
But then subsequently 2012. So if you just decided not to sell and you decided to hold on, take those gains, but then keep riding it as if this blue chip suburb is going to keep going up forever, you would have been really sadly disappointed with it going down 9% over the next 5 years, while the rest of the country went up 37%.
Yeah, so you hang on and you go backwards, or just go eeny, meeny, miny, mo in the rest of the country, and there's a massive opportunity difference for that very simple decision. But that's just not blue chip enough for some people, Luke. What about Sydney, the gateway to Australia, a migrant's paradise, where they all tend to land? It's diverse, thriving. What have you got?
Yeah, absolutely. So very solid inner city suburb of Balmain. You can get to the city by ferry, by bus. It's really close. You've got some water views in parts. And so what you're seeing in 1994, if you bought in then, you'd see 80% growth up to 1999 compared to only 10% of the rest of the country. But then subsequently, the year 2000 to 2005, the growth levels were half that of the national average. So that is a massive thing. That was a massive boom that Australia experienced in the early 2000s, where property prices doubled, but Balmain was a laggard. So once again, went really strong and then fell back.
Yeah, and all the qualities that you're pointing out of these markets, they haven't changed. So you could pick the wrong time to enter the market or the right time to enter the market based on what qualities they've got, and you get a completely different story. Okay, so that's right. Your inner city lefties, and maybe they don't care so much about money. Okay, so let's go for the people with the most money to pour into their properties. What about we go upmarket where all the multimillionaires live? The rich get richer and they can always afford more. So there isn't much more high end than Mossman.
Yeah.
Have we got any blue ribbon suburbs that we can look at?
The massive suburb of Mossman, absolute brand name suburb. And you saw massive growth between 1996 and 2001, where it went up 2.2x. So 120% growth over that period. It's absolute stellar result. But then after that, starting 2003 to 2008, we actually saw it slump with 30% less growth than the rest of the country. So Australia moved ahead 50% and Mosman was only at 20%.
Yeah, these are amazing. I mean, there's so many of them, and they all just seem to flip. And what I've noticed here is you're just picking out 5 years. I mean, we're not saying buy a property, hold it for 5 years, and just sell every 5 years. That's crazy.
No.
But I'm surprised at just how many of these cases fit perfectly into a 5-year window, and you've just chosen arbitrarily 5 years. Yeah.
Yes.
It's
So
amazing.
that's a really good point. The windows do change. You can have long periods where it's just following the national average, but you have these breakouts, and algorithms are able to really judge the length of cycles when they've been going down for too long. Have they had too modest growth over a very long period, or have they gone down too severely over a short period? These are the sort of questions that these models are good at answering.
Yeah, so there are heaps more examples. I mean, these are just examples that we've picked out, but yeah, there is this inverse sort of correlation. There's this back and forth. There's these charts where two competing property markets, they cross over. One gets ahead, the other one catches up, possibly overtaking, and that just repeats itself plenty of times. This chart we're looking at now, Luke. Do you want to explain that one?
Yeah, so we've got two suburbs. One is a town in the Riverina, a beautiful, fertile part of the country, and Maryland's a solid, lower demographic but solid western suburb of Sydney. And what you can see is that these markets move in opposite directions. So it's not a simple case of Australia moving together. In fact, when you break it up into bits, you can find markets that are exactly opposite. So, for example, in the early 2000s, we were seeing Maryland's with annualized growth upwards of 18%, while at the same time, you had Narendra not growing at all, and then the vice versa. So they keep on swapping roles here. So this is a way of thinking about the property market that no one else really thinks about. Everyone thinks about things moving together, but they can actually go in the opposite direction.
Polar opposites. And there's something I just want to say about the force that is bringing this mean reversion into the data. There's an analogy that I have, the apples and oranges analogy, which I hope if you can just bear with me if you've heard this before. Imagine you walk into a fruit shop 100 years ago and it costs 1 cent to buy an apple and 2 cents to buy an orange. Now, if over the next 100 years, apples grow at 4% per annum, whilst oranges grow at 8% per annum, so they are sort of polar opposite growth rates, then you would walk into a fruit shop now and it would cost you 50 cents to buy an apple. It would cost $44 to buy an orange. Now, picture yourself looking at the price of oranges. Long before that absurd price discrepancy occurred, you'd walk into the fruit shop and you go, geez, oranges are expensive. That's ridiculous. I'm not going to pay that much for an orange. What's a cheaper alternative? Oh, apples look good. So that reduced demand for oranges decelerates their growth rate. The alternative, its growth rate accelerates because it's now comparatively far more affordable. And that's what causes these property markets over the long term to balance out. There's this long-term tendency for all property markets to grow at the same rate. They don't all have exactly the same growth rate, but there's just this general rule, this pattern that we've seen in the data. And that's the mean reversion thing.
I think as a home buyer, you can relate to this. So you might consider the suburb that's closer to town. You might say, oh, I consider that to be worth an extra 30 grand for me. But then you drive out and you're like, oh, think of all the savings that we could have if we just went to the suburb further out. We could then get the pool. So people are making all of these trade-off decisions, even bigger ones, whether to live in the city or to live in regional Australia, to make the more lifestyle choice. But of course, when people do decide to move out, they're causing the price to go up in those areas. They're creating demand. And so you end up having this country that is a big patchwork of ratios of the value of one suburb to another based on the value of the amenity that suburb can provide.
Yeah, and you've got another great example of this in this chart where we're comparing the growth of uh, Kelso, suburb of Bathurst versus a suburb of big city, Melbourne, Deer Park.
Yeah.
And yeah, I think I love just how beautifully opposite these sort of mirror images of one another around the long-term national growth rate. There's like a reflection.
Yeah, you can see here that there were like 5 distinct periods where they switched over. So it's not even that like it just happened once or twice. They keep on going in opposite directions, Kelso and Deer Park.
Yeah, so if you can get that timing right, you're at the peaks rather than sometimes peak, sometimes trough. Yeah, that's a great chart.
Yeah. Now people might be saying, "Oh, yeah, Luke, you data scientist, you probably went to lots of effort to find those." And yes, I did go to a bit of effort. That's not typical for suburbs to be inversely correlated like that, but it is also true for larger markets. So the next chart here, I'm actually comparing Darwin to Sydney. So you can see pretty clearly that when Sydney's going great, Darwin is going crap, and vice versa. So it's over longer periods. Actually, this is a shorter time period graph. This is going from 2004. But you can see that you've got this same switchover effect happening here between these two capital city markets, both the capital of their state, if you call the territory a state, and the most diverse economies in the area, and yet they are going in opposite directions.
Yeah, and I cannot count how many times I have looked at a growth chart with 2 suburbs or 2 cities on it. It must be close to 1,000, and it is extremely difficult over a long term, like 20 years, 30 years, even 40 years, to see a case where one market grows faster than the other and just diverges away. This crisscrossing is so stereotypical of growth races, capital growth races between 2 markets. It's very difficult to find a case where you pick out 2 that it doesn't apply.
Yeah, it should be stated that this mean reversion thing happens for every market, whereas outstanding markets that have grown over a long period are much rarer. So it is our interest in creating this algorithm was, what's an algorithm that works on every market for every month over a very long period of time? So we want to take the subjectivity out of the equation and just do stats. Make the bot run over a long period of time, check that it can actually make money without knowing anything in the future.
Yeah. All right. Walk us through this last one. Greater Hobart versus Greater Sydney. Yeah, I've seen this comparison before. Really depends on where you set the start and finish dates of this race, doesn't it?
It does, yeah. I mean, there were some absolute stellar growths in Hobart. If you're looking for the past 4 years, so 2005 to 2009, and Sydney was doing barely anything. So you would think Hobart is if that was your time window, and you were just extrapolating on the curve, you would say, clearly Hobart. It'd be very easy to come up with narrative to say, look, Hobart is a much more better value market. People are going to move from overly expensive Sydney. Hobart is the one to go for in the long term. But then it just flipped over. The fundamentals of Hobart and Sydney still are there, So Sydney is still the major capital. Sydney still attracts the migrants. Sydney still has more diverse industries. Sydney still has nice beaches. And it doesn't change over time. And the market will, just keep on bobbing up and down, trying, but never quite achieving that actual reflection of the fundamental value of the area in the price.
Yeah, and a lot of people will talk about the price growth between 2 endpoints without looking at the chart. So they might say, okay, maybe Hobart is ahead or equal to Sydney right now over the last 30 years, but in the next 10, surely Sydney's going to come good. It's not until you examine these charts that you see all these crossover points that you realize it's a continuation of that trend to cross over, to have good times and bad times. So you can't say Sydney, looking at this chart, you can't say Sydney will eventually come good. It will have some good times and bad times, and there will be continual crossover points.
Yeah, it's interesting. You've got people that are looking at short-term trends in the property market and extrapolating for the long term. And then you've got people like us that have the data going back to 1990, and we're saying, look, break it up into 5-year chunks, 5 to 7-year chunks. We are seeing that the market fluctuates, and that's the most reliable thing is how the market fluctuates over time, and also how the market moves relative to comparable suburbs.
Yeah, and this is not just an anomaly in the data. This is not just something peculiar in the data. This makes perfect logical sense. This whole mean reversion concept makes perfect logical sense. Some property markets just become simply too expensive. We cannot justify paying that much, and so we look for cheaper alternatives, and that's where the mean reversion comes in.
Yeah, there's a universal trait of the Australian property market in that the pricing goes up and down. So there are trends. That is something that you can observe in every market from 1990 to today. They just go up and down. They get overpriced, they get underpriced.
Thanks for listening to the Microburbs podcast. If you have any questions for Luke or our guest, please place them in the comments below. And don't forget to like and subscribe for more great content coming soon.
I think we've nailed it.
Okay. Yeah, I thought you were really strong. I got better towards the end when I just got a bit less nervous and more confident. I think I can get there.